Hey, this is June from Turning Point Life Investment, and this video is for the week ending in May 30th, 2009. So as you know, we ended another calendar month, and let's take a look at the market from a long-term point of view. Let's look at it from a 10-year monthly point of view. So notice what's going on. Overall trend, we always want to look at the big picture, what's going on with the big picture of the market. So market is still down. Right now we're experiencing some pretty decent rally, 3 consecutive months of rally, okay? So just keep in mind that overall trend is down. This is merely just a correction rally. We're correcting this huge decline that we have here, right? And that's pretty much normal. We expect, market always corrects itself after it being so stretched out from the moving averages, as you can see here. So eventually it has to bounce back and touch this 20-month moving average. So I'm not saying we're going to go shoot straight up. I'm probably going to bounce back down up again, some kind of variation like that. So it'll take a few months for that to actually tag this 20-month moving average. But overall, as I mentioned, if I were to drop this Fibonacci down, 38% is a very typical retracement level. So that would bring us towards the 100 level on the SPY. 50% will bring us up to 110. So anything deeper will be the 62%. That will be up in the 120, which I probably won't think it will hit that high, but you always got to watch out for these levels. If one breaks, then obviously the next one will most likely get hit. But at least I would say a 38% is a good minimum for a type of retracement. Okay, zooming in on time frame just a little bit, we have a 3-year weekly view. Really nothing really has changed from last week. We're still going sideways. The bulls just don't want to throw in the towel yet. They're keeping prices higher. Every time there's a dip, people are coming in to buy, and the bears aren't exactly here to push the prices down lower. So we're more or less still in some kind of sideways consolidation. So what I'm going to do is just jump straight into a 6-month daily view. So, I mentioned last week that I expected some kind of zigzag type of correction. So, obviously that didn't happen. But at the same time, I also mentioned that prices or corrections can take many forms, such as a rectangular or sideways pattern, or some kind of triangular pattern. And it seems like so far it's just going sideways right now. Now, I understand on Friday we had this last-minute push higher. Let me just kind of take away some stuff. We had a last-minute push higher on Friday, but you have to look at what is the overall range of prices right now. We're still stuck in the range with lower support around 88 and upper resistance around 93. So on Friday we didn't get a true breakout yet. We had a nice push higher, but we didn't close above it. Okay. So either A, that was a head fake, all right, trying to trap the bulls into buying, all right, or it could be a precursor to things to come. So we don't know exactly what's going to happen, and especially since we finished the month, we'll probably get a better idea of what direction we'll be starting next month. But overall, you can, if you've been trading this last week, you notice how the market was pretty choppy, and that's pretty a good indication that it's consolidating, it's correcting. Correction is usually marked by a lot of choppiness, a lot of whipsaws, because both parties aren't really sure where to push the market. So that's why you get this kind of tug of war back and forth between the bulls and the bears. So not until we get a really clear break, I would say even a close above 93, can we really say that this market is done correcting and we're ready for the next leg higher. And vice versa, if we have a close underneath 88, that definitely means that there's more correcting to come. So let the market tell you what to do. Don't try to force it, or don't try to predict what the market is going to do. Watch for these resistance, watch for the support. If it breaks, then you would have a trading plan according to what you would do if support is broken, right? How are you going to play to the bearish side? And likewise, if resistance is broken, how are you going to play to the bullish side? Okay, so you always want to prepare for both scenarios, or heck, even if we continue to go sideways, how are you going to play that, right? Maybe you can do some iron condors, whatever the case might be. Honestly, it's really up to you. You can get pretty creative with these option strategies. Okay, next going into the VIX, looking at the sentiment, same thing. It's not really telling us anything that we don't know already. Prices or VIX has gone sideways. So sentiment-wise, it's not extremely bullish. It's not extremely bearish. I mean, overall, we are more or less extremely bullish because we're back down to the 20s right now, high 20s, which we haven't seen since last year before the whole decline happened. So, overall, long-term wise, we are leaning towards the more extreme bullishness, but still the market hasn't reacted to that level, to that extreme level of the VIX yet, and still there's still divergence going on with the MACD. But until there's some catalyst, until there's some reason for either for people to buy or for people to sell, this market will continue sideways. So maybe it's next month. I mean, we'll see something going on next month to push this market somewhere. But if nothing's going to happen, then basically you can expect more sideways consolidation. So just watch your stops. I would say in this type of environment, I would say just trade lightly. It's not something to be holding a lot of positions, especially in this choppiness. When the market's trending, then you can load up a little bit more. But in this sideways correction, it's better to be playing on the safe side.